Hello, let me take you on to a roller coaster ride of a phenomenon called IPO. It is fast, it is bold, it is unpredictable, and has a lot of ups and downs as well. In this video, I will take you through the high voltage life cycle of IPOs. IPO stands for Initial Public Offer. It is a process by which a privately held company offers its share to the public for the first time. This transition makes the company a publicly listed entity on the stock exchanges like NSE and BSE, allowing the general public and institutional investors to buy its shares. The primary goal of an IPO for the company is to raise capital for various purposes such as business expansion, debt repayment, or funding new projects. But for investors, IPOs presents an opportunity to invest in a company's growth potential from an early stage. Let's check out the entire life cycle of IPO and retail investors' roles, activities, and considerations along the way. This graph shows the life cycle of an IPO. The entire life cycle can be divided into five stages. Number one is the pre IPO stage, number two is the IPO stage, number three is marketing and subscription stage, number four is allotment and listing stage, and finally, number five is the post listing stage. Let's now go into the details of each stage, starting with the for number one pre IPO stage. So the pre-IPO stage consists of five broad activities. First is a decision to go public. The company's board of directors decide to raise capital by offering shares to the public. Number two is the appointment of merchant bankers and lead managers. The company hires investment banks, which are called merchant bankers, to manage the entire IPO process. They provide guidance, handle documentation, and market the IPO. Multiple lead managers may be appointed for large IPOs. Number three is due diligence. The merchant banker conducts a thorough review of the company's financials, operations, legal aspects, and future prospects. Number four is the draft red herring prospectus (DRHP) preparation, a detailed document containing information about the company, its business, financial performance, risks, and the purpose of raising funds is prepared. And number five is filing that DRHP with SEBI. The DRHP is submitted to the Securities and Exchange Board of India, that is SEBI, which is the regulatory authority for the Indian securities market, for its review and approval. At SEBI's end, SEBI ensures that all necessary disclosures are made to protect investors' interests. For small and medium enterprises, SME IPOs, approval is needed from the stock exchanges, not directly from SEBI. Now let's see the investors' activities or roles in this stage of the IPO life cycle. So the retail investors come to know about probable IPO through news articles and social media at this time. Once the DRHP is filed, they can go through the DRHP on SEBI's website. So at this point of the life cycle, the investors or the potential investors only know about the possibility of a IPO because the company has filed a DRHP, and the same can be viewed on SEBI's website. Let's move on to the next stage, which is the IPO stage. So this stage consists of four broad activities. First is the SEBI review and approval. SEBI reviews the DRHP that has been filed by the company or the merchant bankers for completeness and accuracy. It may raise queries or suggest changes. Once satisfied, though, SBI issues its observations or the approval. This process can take 2 to 4 months. So it's a quite a lengthy process. Next is the application to stock exchanges. After SEBI's nod, the merchant banker submit the IPO application and DRHP to the stock exchanges, NSE and BSE, or in case of SME, probably either one, for their in principle approval. Next, at number three is price determination. Now, the company and the lead manager decide on the issue price or a price band for the shares. This can be done through either fixed price offering or second book building offering. In fixed price offering, the price at which share will be sold is announced beforehand, whereas in the book building offering, a price range is announced and investors bid for share within this range. The final price, that is the cutoff price, is determined based on the demand received at different price points. And the fourth activity is the red herrings prospectus submission, RHP submission, a very critical activity. An updated version of the DRHP, that is the RHP, is filed with the stock exchanges. It includes the price band, IPO timeline, and other relevant details for investors. Now, once an RHP has been filed, that means the IPO is nearing, and this is the time when the investors should get active. So, following are the activities of the investors in this stage. So, they should read or go through the RHP, at least the on a broader basis, analyze the company's fundamentals based on RHP, and start reading the brokerage reports and analyst opinions about the company. Irrespective of how careful you are in reading through or going through the RHP, there are chances that you might miss something. So it is always good to read brokerage reports and analysts opinions about the upcoming IPO in which you are interested. Let's move on to the next stage, which is the marketing and subscription stage. It has broadly four activities. First is the roadshows. The company and the lead managers conduct roadshows and investor meetings in different cities to generate interest among potential investors, including institutional investors and high net worth individuals specifically. Number two is the anchor investor bidding. Now, before the IPO opens to the public, a portion of the shares may be offered to anchor investors, QIBs, with a minimum bid of 10 crore rupees. The allotment to anchor investors is usually done one day before the public issue opens. So QIB is not for general public. It is for qualified institutional buyers only, and the minimum ticket price is 10 crore rupees. Next is the IP opens for public subscription. Now this is where we as an investor have to be at the top of our game. The IPO is open for a period usually of 3 days, during which retail and other investors can submit their bids to purchase the shares. Applications are typically submitted through brokers or banks via the stock exchange's IPO platform. Investors receives a unique application number. And fourth activity is the bid revision. So, in a book building IPO, investor can revise their bids within the subscription period. So, the activities for the investors in this stage is, first of all, check brokerage reports and analyst opinions for their view about the IPO. Consider gray market premium. Now, gray market premium GMP is an indicator of how much demand is there in the market for the upcoming IPO. So it is just an indicator, but remember that one thing, it is just an indicator, it's not everything. And finally, apply for the shares during the bidding window. The shares can be applied either in the retail category or in the HNI category. HNI is further divided, classified into small HNI and big HNI. This is for main board IPO. For SME IPOs, there is retail and HNI category. Retail less than 2 lakhs and HNI more than 2 lakhs. In main board, retail is less than 2 lakhs, small HNI is between 2 to 10, and big HNI is from 10 lakhs onwards. Now you can apply, and anyone can apply in any category. So it just depends upon how much amount you are bidding for. There is nothing to declare about which category you want to apply or anything. It is just depends upon how much you applied actually. So the application can be done via online via DMAT and trading account, or through banks net banking, ASBA, via UPI, or finally there is an offline form as well, physical form, which can be submitted. Let's move on to the next stage, which is the allotment and listing stage. This comprises of six major activities. First is the bidding closes. So the IPO subscription period ends on a predefined day and time. Next is the basis of allotment. The company and the registrar, an entity appointed by to process applications, finalize the basis of allotment, determining how shares will be allocated to the applicants. In case of oversubscription, which is generally the case these days, allotment is often done through a lottery system for retail investors. Number three is share allotment. So shares are allotted to the successful applicants and the corresponding amount is debited from their bank accounts if they have used ASBA, which is the application supposed by blank by blocked amount, supported by blocked amount facility. The amount is unblocked for unsuccessful applicants. Next activity is the refund, which is if applicable. So in case of unsuccessful or partial allotment, the applicants receive refunds accordingly. Next is the demat account credit. The allotted shares are credited to the investors' demat accounts. And finally, the listing on the stock exchanges. The company's shares are listed and begin trading on the stock exchanges. This marks the entry of the company into the secondary market, where investors can buy and sell the shares among themselves. The listing date is decided by the company and the stock exchange. Now let's see the activities for the investors. So the check allotment status. So once the bidding is done in the last stage, the investors have bid for the shares. They have to check the allotment status. They can check allotment status either on the website of the registrar of the IPO or on the NSE or BSE website or the brokers platform. And they have to wait for share credit or refund in case of unsuccessful bidding, and finally take decision to hold on to the shares for a longer term or sell the shares on the listing day itself or whenever they want. So it's up to the investor to decide. Let's move on to the final stage, which is the post listing stage. This basically consists of two major activities. First is the secondary market trading, and second is the post IPO obligations. So, in secondary market trading, the shares are now freely traded on the stock exchanges. The price of the shares is determined by the market forces of supply and demand. Number two is the post IPO obligations. As a publicly listed company, the entity is now subject to various regulations and compliances requirements, include regular financial reporting, corporate governance norms, and disclosure of material information to the stock exchanges and investors. So this is the entire life cycle of the IPO. Now, finally, let's see some key considerations for the investors in an IPO before moving on. So, uh, for the investors, the decisions or the activities are they have to take a decision or buy, hold, or sell. So those who didn't get any allotment can buy new shares in the secondary market now. They can hold the shares that they have allotted, or they can sell the shares that are allotted. They have to monitor company's performance from now on, and they have to remain aware of the domestic and foreign factors affecting the company. Now let's see the key considerations. So the key considerations are, so due diligence is crucial. First of all, never invest in an IPO without thoroughly understanding the company and its prospectus. Very important. Next is the gray market premium. GMP are just one of the several indicators available. Do not take investment decisions solely on the basis of GMP. Extremely critical. Next is the risk factors. IPOs can be risky investments. The price of the shares can go down after listing, so be prepared for potential losses, at least for the short term. Next is the investment limits. Now, for the retail user, that limit is below 2 lakhs. For uh, HNI, for a small HNI, it's 2 to 10 lakhs, and for big HNI, it's 10 lakh onwards. Next is the one application per PAN. Very important point. There could only be one application per PAN. So if you have accounts with multiple brokers, do not commit the mistake of applying in the same IPO from different accounts, from different broker accounts. There could only be one application per PAN. Next is the matching details. So you have to ensure that the name and other details in your IPO application must match with those in your Demat account and bank account. Finally, 2 points. First is the FOMO. Don't fall for fear of missing out. If you do not find the company's business growth opportunities satisfactory to your level, do not apply. There is always another IPO in the line. Do not commit to an IPO just because others are doing it. And finally, oversubscription. So most good IPOs are oversubscribed, meaning the demand for shares exceeds the number of shares offered to retail investors. This often leads to partial or no allotment through a lottery system. If you have not got the allotment, wait for a few weeks for the prices to settle down after the listing and then take further decisions. So that is all from my side in this video. I hope you have found this video insightful and have learned something new today. Thanks for watching this video. If you have liked it, please press the like button and subscribe to the channel. I'll be back soon with another video. Goodbye for now.